If you're an Indiana public school teacher and are looking to maximize one of the biggest benefits when it comes to your retirement, the Indiana Public Retirement System, otherwise known as INPRS, this is the video for you. In this video, we're going to find out the 3 ways you can be fully eligible for your monthly benefit, how to calculate your retirement monthly benefit, and what to do with what's called the defined contribution account, which is a big part of your INPRS benefit. My name is Evan Kaufman. I'm a financial planner with Kaufman Wealth Management. I hope you can find some information that can really benefit you now and in the future. Today we're going to go over what's called the hybrid plan. This is the default unless you choose otherwise. Now about 95% of the people that I work with are under this plan, so we're going to go with that today. The hybrid plan consists of 2 parts. Hybrid. One is the defined benefit and how you are fully eligible for this, which is the monthly check that you get in retirement, is as follows: age 65 and 10 years of service, age 60 with 15 years of service, or age 55 with 30 years of service. And that's also called the rule of 85. So the rule of 85 states your age plus your years of service has to equal 85 or above, but you also have to be a minimum of age 55. So if you're 55 and 30 years of service, that equals 85, so you will get the full benefits. If you're 56 and 29, that is still equal to 85, so you would get the full benefits. If you're 54 years of age and 31 years of service, that equals 85, but because you're below the age 55, you're not eligible for full benefits. So you want to make sure that you're keeping track of that to make sure when you can be fully eligible for retirement. That defined benefit is calculated as follows: your 5 highest average years salary times your years of service times 1.1% and then divided by 12 months, and that equals your monthly benefit. Now what I pull up here you can find exactly on the INPRS website under calculators, and what you can do here is you can put in your actual numbers. So for here I put as example $75,000 as the 5 highest average years salary and 35 years of retirement credit. And when you do 75,000 times 35 years times that 1.1% in the formula we saw earlier, that equals an annual benefit of $28,875. And if you give it to you monthly, right here, that 5 years certain in life divided by 12, that's $2,406.25. Now, as you can see here, there's 5 different payouts, and I'll go through each one of them. So the 5-year is the first part. That's the default. That's where you get that $28,875 divided by 12. $2,406 a month. And what that 5-year certain means, let's just say that you retired today. And if you die within any part of that 5 years, the payout will be paid until that 5 years is up. So if you retire today and you died 3 years after you claim benefits, that means your spouse or whoever you named your beneficiary would get 2 years of your checks. The next payout is straight life, $2,422 a month. That's actually a slight increase from the 5-year certain. The reason why it's higher than the 5-year certain is because they're not guaranteeing that 5 years. If you pass away after a month, nobody gets a nickel. Then we go down to the 50% survivor, which we'll talk about first, at $2,258 a month. That's about a $150 a month decrease in your benefit. But because you're doing that, they're going to pay your spouse or whoever you name your beneficiary $1,129 a month, which is 50% of that $2,258 for as long as they live if you predecease them. If you step up one, 66 2/3% survivor, that's $2,200 a month, basically a $200 decrease from that original 5-year certain life. And now your spouse, if you predecease them, will get 66 2/3% survivor. So that's $1,473 for as long as they live now. And the last payout, 100% survivor, $2,113 a month. That's about a $300 a month decrease. But that gives your spouse, if you were to predecease them, the same amount, $2,113. Keep in mind that these survivor benefits can vary by a lot of factors. The most one being age. If your spouse or survivor is younger than you, they're probably going to have to pay them longer than they're going to have to pay you. So they're going to charge you accordingly. So it does depend on your spouse's date of birth, gender, all those sorts of things. So keep that in mind. Let's go back to the main two parts of INPRS. We've now defined the defined benefit because now we know how to calculate it, how we can be fully eligible, and the different payouts and how we could choose survivorship on that. Let's take a look at the defined contribution now. That's the mandatory 3% of gross wages contributed to you. What that means in plain English is that 3% of your check is going into this account. So if you make $75,000 in a given year, that's $2,250 going towards your behalf in an investment account that you can invest for your future that can grow over time. Let's take a look at an example. What you see on my screen now is an example of what you would see if you were to log in to see your account. Obviously here there's zero balance because this is an example, but sometimes depending on your work history, salary history, and your investment choices, there could be tens if not hundreds of thousands of dollars in this account. So let's make sure those dollars are working for us accordingly in the investments. What I'm looking at here is a list of the investment options that you can choose within your defined contribution account. I got this directly from the INPRS website. The first one here, down here, the fixed income fund, that's a very low volatility and assumingly low rate of return. Inflation linked fixed income, also very low volatility, not much in ups and downs, but also very low return. International fund, that's investing in international companies. Large cap equity, that actually tracks the S&P 500, which is the 500 largest US companies. A money market fund, again, that's very low volatility, very low rate of return. The small and mid cap equity fund, that's small sized and medium sized companies. The next one is the stable value fund, which used to be the default. Now I see a lot of people in this and they don't even realize what it is. You're basically in cash, not making much of a rate of return. Depending on your situation, that's probably not the best option for you. The last investment choice is what's called a target date retirement fund. What that does is, first of all, it includes international, large cap, small cap, and mid cap stocks all within the fund. So you don't have to guess, how much percent do I put in international? How much percent do I put in large cap growth? How much do I put in small and mid? It does that all for you. It's instantly diversified. The other thing with target date retirement funds is they go by years, usually by 5. And it most closely represents your 65th birthday, the year in which you turn 65. So if you're 50 right now, and it's 2026, that means you got 15 more years, you're probably in the 2040 fund as the default. And what that means is, let's say this is 2040 and this is us now. The farther we are away from 2040, the more aggressive the fund is going to be. And as slowly as you get to 2040, the more conservative it will become. Target date funds are now the default. So if you are going to turn 65, let's say in 2050, that means you're going to be in the 2050 target date fund. Sometimes what I find with these target date funds is that they get too conservative too quickly and leave growth on the table. So sometimes what I tell people to do is, yes, your 65th birthday is going to be in 2050, let's say, but let's bump that up to the 2070 fund. Let's put our foot on the gas so we're not leaving any growth on the table, maximizing what they can do over the course of their career. One other point that I would like to make is that after or close to retirement, what do you do with that bucket of money that you've been accumulating in your defined contribution account? You can do a couple things. You can cash it out and put it in your wallet, but IRS would really like you because you'd pay taxes on the entire amount. And if you're below 59.5, you'd actually pay penalties on that as well. Most of the time people do not do that. The other thing you can do is also sign back that portion and give up all rights and privileges to that balance back to the state. They set you up with an insurance company and give you a second check in addition to your monthly benefit. The third thing you can do is just leave it in the account there. The fourth thing you can do is actually roll it into what's called a traditional IRA. Now it's separating from INPRS and putting it in your name. Better investment choices, more flexibility, and now it's not tied to an employer, it's under your name only. That's what most of our clients do, and that's where we come in and help you manage and pick investments to better suit your goals and needs. As you can see, as we layer on more and more details from the INPRS account, you can see that it becomes more complex very quickly. And that's where a financial professional like myself or anyone at Kaufman Wealth Management can help you to better optimize your situation. Look at other accounts such as 403Bs, 401As, IRAs, Roth IRAs, 401Ks from old employers if you weren't a teacher your entire career, things like that. That's where we help. If you want more information, go to our Kaufman Wealth Management website. That can be found in the description below, as well as my phone number and email that you can reach out directly to me. Once again, my name is Evan Kaufman. I'm a financial planner at Kaufman Wealth Management. I hope you enjoyed this video and learned something today. Thank you.